Welcome to Tea at Taxevity, where you get insights from insiders, our many clients and collaborators. I'm Pramod Sharma, your actuary at Taxevity Insurance. We transfer financial risks with life and health insurance. Today we have a special guest for an important topic. Who are you and what do you do when you're not being interviewed?
Thank you. My name is Mike Dunn. I'm a financial advisor, and when I am not being interviewed, I try to take the complexity out of individuals' financial situations, and I do try to squeak in the odd round of golf.
Okay, well, we try and get rid of complexity for our clients, but not a golfer here. So we won't be meeting on the
Not
golf
everyone
course.
is.
Where is your office located?
I'm located in Richmond Hill, just north of Highway 7 and just west of Leslie.
Okay, our topic today is segregated funds. To start, what is a Seg Fund?
So a Seg Fund is essentially an investment portfolio with insurance. And before I go any further, when I say insurance, it doesn't mean that somebody needs to qualify medically. I think that's a super important part. So the way to think about it is like a piece of candy. You'll see where I'm going with this in a second. So if you have a piece of candy and it has a wrapper around it and you drop it on the ground, chances are the candy's protected, so when you open it up, you can eat the piece of candy. It's similar to an investment portfolio when you put some insurance wrapped around it. So if you're looking for something that guarantees you on death, maturity, or some income, you're putting insurance around your money and essentially protecting yourself.
Okay, so what is the insurance actually doing?
Well, there's a few things. I really focus in three areas for a segregated fund. Number one would be ensuring an income. So for a client that doesn't have a pension plan or no guaranteed income, I mean, myself as an advisor, I don't have a pension plan. So it would do one of three things: ensure your income, ensure that your capital is protected from point A to point B. So usually it's about a 15-year maturity, or upon death. The million-dollar question, no one knows when they're going to die. So it's putting some protection on when the inevitable happens.
Okay, so is the guarantee providing a certain amount of money that goes back to the client, like a floor of some kind?
Yeah, so I always use $100,000 as an example.
Sure.
So let's use the death benefit guarantee, because this is really, I think, where we should focus on this. I mean, our population is aging. A lot of boomers are selling their house, and really they don't need the money, and they want to pass it on to the next generation. So $100,000, a client puts in $100,000 to a segregated fund.
Okay.
And then they're guaranteed that $100,000, providing they don't take money out. So if they took $10,000 out, then their guarantee on death would be $90,000. So it's fairly straightforward. But we don't know what the markets are going to be doing when we die. Like, for example, if somebody died in 2008, 2009, when the markets were down 30-40%, just a standard stock portfolio or a standard mutual fund portfolio, their family was only getting whatever the market was. So they're not getting any guarantees.
Okay. And because there's an insurance element, does that mean that you can name a beneficiary?
Yes, that's actually one of the reasons why I use these for clients. Back to the example of a boomer maybe that sells their house, or somebody that's really north of 65.
Mm-hmm.
When you sell your house, that's all non-registered money. You don't have RSP opportunities really at that age. You have a tax-free savings account, but you're limited to how much you can put in. So let's say that somebody had $100,000 non-registered money. If it's sitting in a GIC, a bank account, somewhere in there, you can't put a beneficiary on the account. So with a segregated fund, is you essentially wrap a beneficiary around your portfolio, And upon death, it's a quick transfer of assets. It doesn't get tied up in the estate.
Okay, so there's no probate involved with this then?
I can never say for sure that you can avoid 100% probate, but it does help avoid probate. There's a lot of certain things that that we need to be aware of. I can't just say one thing fits everybody. Everybody's situation is different. But I do use the 100% death benefit segregated fund as an estate planning tool for sure.
Okay, now if the value of the segregated fund increases, so it's worth more than 100,000, maybe it's 150, 180, whatever, then is there a way to lock in that higher value as the floor?
Yeah, there is. It depends on the age of the client. You know, everything we do in this industry is the best answer is it depends. There's a lot of different scenarios, and there are seg funds out there that you can reset the death benefit. There's many insurers that offer these, and part of my job is to find the best one for the best situation for the client. And some of them have annual resets up to a certain age, usually age 80.
Okay.
So you can lock in that death benefit every year as you go. Some companies, it's every 3 years. So again, that's up to me to determine which one suits the client the best.
Okay, now when it comes to investments, people talk about fees and they want them to be as low as possible.
Yeah.
Where do seg funds fit into the spectrum of fees?
In my industry, you can't have a conversation without this topic, right? So,
Right. I thought that's why we should raise it here.
So before I go into detail about that, first and foremost, for anyone watching this, if they watch TV a lot and they see these commercials on fees, that's a fraction of the story. So if this conversation or somebody is just all they're concerned about are fees, you're never going to win it on a seg fund conversation. I'd say on average, a seg fund is probably 1% higher than the average mutual fund.
Okay.
But again, for me, the way I run my business is I try to do what the best thing for the client, given what I know about them, for the cheapest cost. You know, I'm fee sensitive. I hate paying what we pay for gas. I mean, we're all in the same boat when it comes to that. But at the end of the day, it's really up to the client is this extra 1% or whatever it is worth it to what you get? Like, for example, you go buy a car, you know, if you don't need GPS, if you don't need power windows, if you don't need all this stuff, then the cost just is not going to make sense to you. But if insuring your money is important to you, protecting your income is important to you, then I would say that these are a moot point.
And that's a good point. I know that people focus a lot on fees, but as you're saying, it depends what you're getting for the money. For example, in the winter, I'm pretty happy to pay more for heated seats.
Yeah. Well, that's why I live in a condo, because then I don't have to worry about scraping off my car or anything like that. But that's what condo fees go for, right? So, you know, it's really, in my line of work, it's really understanding what the client wants, what they're looking for, what their situation is, and presenting, you know, everything that they could do. And ultimately, they're the ones that sign the contract. So I'm not going to force somebody to do anything like that. But they are a bit more expensive. So let's not sugarcoat that. But again, you get what you pay for.
Right. And yeah, that's something that's important to consider. Who do you find the ideal clients for segregated funds are?
So back to there's 3 scenarios or 3 broad client base that I would use a seg fund for. The first one would be somebody that does not have a pension plan. So when I talk to clients about retirement income, you know, there's multiple buckets that you can use for income, and some of those are guaranteed buckets. Like we have CPP and OAS, which are coming in from the government. If you have a defined benefit pension plan, which is very difficult, especially for younger clients to get,
Mm-hmm.
so we look at what kind of income somebody is gonna need, and then we decide whether or not we should guarantee some of that. And again, it's up to the client. I mean, it's easier to sleep at night when the market's not going to affect what your income is going to be. So guaranteed income would be one. The second one would be, older clients, usually 65 and plus, that have some money that they're really not going to spend. Insurance is a great way to leave a legacy, but not everyone's insurable. This also used for estate planning. So really the purpose is, how many times have you heard somebody say, I don't want to spend my money, I want to leave it to my kids.
Mm-hmm.
This is a great way to do that. And you can also set up a trust, but trust get expensive. There's a lot of different ways you can leave money, but this is a very simple way. And let's say 10 years down the road, you needed that money. You got sick and your family needed the money to help pay for your care. You can always sell it at the market value. It's always there for you. So you're not losing liquidity. And the third area where I use these would be self-employed individuals, professionals that might have some liability with the business that they do. So similar to probate, I can't guarantee that these are creditor proof. Every scenario is different, but because they are governed by the Insurance Act, they tend to be and have the listed beneficiary. They're great for a business owner to protect their personal assets, not their corporate assets, but their personal assets. So those are the three areas.
Right, and there seems to be more litigation all the time. So if you can have some creditor protection, then that's a good way to get some peace of mind.
Yeah, for sure. Really, the word or the phrase that describes seg funds really are peace of mind. They're very relevant. I mean, October, that was a terrible month in the markets. Our macro economy, there's a lot going on. And the one thing that everybody has in common is we're all getting older. And
right.
I mean, just calling it how it is, but it's true. I mean, our population in Canada is getting older. There's a big wealth transfer coming in from the parents of the boomers to the boomers, which come down to individuals like myself. So seg funds are a great way to help money come down from one generation to another. And one thing I want to note too is that on the estate planning side, I've been through a few estates over the last year with some of my clients. And when you think an estate is simple, you're wrong. They're never, ever simple. So a seg fund can be used, especially in a scenario. Let's say a client has even just $100,000 sitting in the bank, maybe in a GIC or something. That money is tied up in the estate until it's settled. The executor can go in and provide documents and get access to the bank account, but they're restricted to what they can pay for using the deceased bank account. So similar to an insurance policy, a seg fund is settled very quickly. Usually within a month, the money is in the hands of the beneficiaries, which, you can't, there's no money that could, that somebody could receive to make up for the loss of somebody. But, there's the stress and the pain of losing somebody, but then there's also the financial stress. And this can really help put some money in some hands of beneficiaries that need it when somebody passes away.
Right. There's definitely peace of mind if someone is able to get money quickly. And that's
Yeah.
one of the things that insurance and segregated funds are able to provide.
Yeah, definitely. Definitely. It's not like I would never, like anything I do, I would never recommend somebody put all of their money in one thing. I mean, you're a tax guy, so there's going to be tax. So you need to make sure that there's money in the estate to pay tax. But this really, it all goes back to similar to what you do is, you know, you analyze somebody's situation, you provide, you know, the best advice you can given that scenario. Because there's nothing that I'm going to say here that applies to everybody, and everybody's situation is different. So that's important for viewers to know that.
Right, definitely. So what's your key message for the people watching?
My key message, I mean, there's many things. I have a ton of key messages that I get, but really, you know, given the media and everybody talking about fees, you know, I would really focus on what you're looking for with your money. I mean, it's your money, it's your family. I would never say that I'm not interested in something because it's too expensive. But I would encourage you to, if I touched on some subjects that, you know, might be meaningful to your situation, you're interested in learning more, you know, I would have a conversation with a trusted advisor. You know, I focus on financial planning, and if an advisor doesn't have a CFP, they technically can't call themselves a financial planner. So I would, you know, I would really focus on, you know, what's important to you and have conversations around what's important to you, not about what's important to, you know, the bottom line of a company.
Right, great points. What's the best way for people to reach you?
Being younger, email is very good. I'm always on email, so email's great. And I'm old fashioned. I like to talk on the phone. So email and telephone are the two best ways to learn more, to, you know, ask me questions. I'm very open with questions. I love answering questions because education to me is just a beautiful thing.
Okay, and then what's your email address and phone number?
So my email address is Mike, M-I-K-E .Dunn, D-U-N-N @IPC Securities. There's an S on the end there. It's always forgotten, .com. So Mike.Dunn @IPCSecurities.com. And my telephone number is 647-339-9807.
Okay, thank you very much for being our guest.
Excellent. Thanks for having me.
Okay, that's the end of our episode. Thank you for watching.